Hello everyone, let me introduce myself. My name is Desilawati, NPM 244121010, Accounting Study Program Class AKT 24A. In this video I will discuss about understanding accounts in accounting, and 5 types of accounts, explaining the normal balance in each account, then explaining how to enter transactions in the general journal. What is meant by account in accounting? In accounting, an account is a note or recording used to collect, classify, and process financial data related to a particular transaction or economic event. This account functions as a place to store financial data that is used to create financial reports, such as balance sheets, profit and loss reports, and cash flow reports. Accounts have several important functions in accounting, namely: collect data, classifying data, processing data, making financial reporting. In accounting, there are 5 main types of accounts, namely: 1. Assets, assets/treasures. This account records the value of goods or services owned by the company, such as cash, receivables, equipment and fixed assets. Assets are divided into 3, namely, current assets, fixed assets and intangible assets. Current assets: cash, banknotes, coins, bank account balances, and checks. Notes receivable, written commitment from a customer to pay a certain amount of funds on a certain date. Accounts receivable, future cash payments for sales of goods or services on credit. Supplies, short-lived company items, such as pens and paper. Prepaid expenses, rent is prepaid, and insurance is prepaid. Non-current assets: long-term investment, stock or bond investment. Fixed assets, buildings, land, machinery and equipment. Intangible assets, patents, copyrights, and goodwill. 2. Liabilities, liabilities. This account records the value of obligations that must be paid by the company, such as bank debt, trade debt, and other obligations. 3. Equity, capital. This account records the value of the capital owned by the company owner, such as initial capital, retained earnings, and private. 4. Income, revenue. This account records the value of income received by the company, such as sales, commissions and other income. 5. Expenses, this account records the value of costs incurred by the company, such as operational costs, production costs and other costs. In accounting, classifying accounts is very important because it can help companies manage finances and make the right decisions. Each account has a normal balance that varies depending on the account type. The following is a detailed explanation of the normal account balance for each account in accounting. Asset account. Normal balance, debit. Examples: cash, receivables, inventory, and fixed assets. Active accounts have a normal debit balance because these accounts increase the value of a company's assets when filled with a larger amount. Liability accounts. Normal balance, credit. Examples: debt, long-term debt, and other liabilities. Liability accounts have normal credit balances because these accounts increase the value of a company's liabilities when filled with a larger value. Equity account. Normal balance, credit. Examples: capital, retained earnings, and dividends. Equity accounts have normal credit balances because these accounts increase the value of a company's equity when filled with a greater value. Revenue account. Normal balance, credit. Examples: sales revenue, service revenue, and other revenue. Revenue accounts have normal credit balances because these accounts increase the value of a company's revenue when filled with a greater value. Expense account. Normal balance, debit. Examples: production costs, operational costs, and other costs. Expense accounts have normal debit balances because these accounts reduce the value of a company's revenue when filled with a larger value. Overall, normal account balances in accounting depend on the type of account and function within the company. By understanding normal account balances, companies can create accurate financial reports and better monitor financial performance. The following are the steps for entering transactions into the general journal. 1. Transaction identification. identify transactions that occur, such as sales, purchases, or cash receipts. 2. Determine the accounts involved. Determine the accounts involved in the transaction, such as the cash account, accounts receivable account, or expense account. 3. Determine normal balance. Determine the normal balance for each account involved. 4. Create a general journal. Create a general journal by recording the transactions that occurred, the accounts involved, and the normal balance for each account. 5. Posting general journal. Post the general journal to the general ledger to update the account balance. Example. Company XYZ makes sales of IDR 100,000 to customers. The following are the steps for entering transactions into the general journal. Transaction identification, sales of IDR 100,000 to customers. Determine the accounts involved, sales account and accounts receivable. Determine the normal balance. The normal balance for a sales account is a credit, while the normal balance for a receivables account is a debit. Create a general journal. Credit debit account date. February 10, 2023 sales 100,000. February 10, 2023 receivables 100,000. Post the general journal to the general ledger to update the account balance. Thus, the sales transaction has been successfully entered into the general journal and the account balance has been updated. That's all the material I can convey. Hopefully it can be useful for all of us. I thank you.